This is the problem with these big public companies. Adobe and all of their investors got very addicted to the free cash flow generation of that stock. And it's been an incredible performer. And let's just be honest, Shantanu is one of the best CEOs of the last few decades in the public markets, period, end of story, okay? Since 2007, he has just run a masterful playbook. At the tail end of that, though, in 2022, this is a company that has, I think, 6 or 7, maybe $8 billion of free cash flow. It is a gargantuan money-making business. And so they refused in Creative Cloud to go to that free tier that Figma has. And if you look at all of the stories around Figma, one of the most powerful things they did was basically allow people to use this for free effectively forever.
Yeah, bottom-up SaaS. Yeah, absolutely.
And the problem with Adobe is that's a business model disruption that they could not afford in the public markets. Because if you condition a set of institutional investors to be expecting $7 to $8 billion of annual free cash flow, and all of a sudden you're willing to torch it to take a quarter of that and make it free, that is probably the biggest reason why they had to buy this thing, which was that they needed to tuck it in. And they're like, how can I do it? Well, I just have to do it by diluting the stock. I think there's another takeaway that's really interesting here, which is that if you look at big tech companies, I think you almost have to sort them into 2 buckets, at least in the enterprise. And Sachs, you can tell me if you disagree, but there's one type of enterprise company which makes basically a single linear monolithic product, or a handful of those monolithic products, right? Think Workday, think Adobe, et cetera. But then there's this other type of company, which are more platform level businesses that have this, mixture of things that they do relatively well integrated. Maybe each product is not so great, but together they're pretty decent, and you have distribution leverage and you have pricing power. Think Microsoft and the totality of those products. So what's interesting to me is you cannot effectively compete, as it turns out, against Microsoft at any point product. And Slack, I think, is the best example where, Microsoft Teams was fundamentally cannibalizing this business, which is what drove Slack into the arms of Salesforce. And, you could say that Teams was not as great of a product. I would make that claim. But what Microsoft had was distribution scale and pricing power where you could discount and effectively give it away for free. Adobe isn't in that situation, right? They can't do that kind of stuff. And so when you compete against those kinds of businesses, you have a better chance of winning. The takeaway, I think, for the entrepreneur is when you're thinking about the next enterprise business to start, I would try to bucket these companies that you want to compete with and say, if I'm going to build a newer version of X, make sure that version of X is going after a company like Adobe versus a company like Microsoft, because it's much, much, much easier to build value when you're competing against a monolithic product company versus an entangled platform company. I think you nailed it on the head, Sachs. It's an impossible strategy to defend against. The other thing that is interesting, by the way, about all of this is, if you think that the valuation, the takeout premium, was basically 2x post to post, what that means is that if Figma was last valued at 10 is now worth 20, does that mean that Canva, which was last priced at 40, is worth 80? Well, potentially to Adobe, right? And if you add those two together now, what you really have is basically the entire totality of the Creative Cloud for Adobe is basically embedded now in these two businesses at an extreme premium. And so it makes it very difficult now, I think, as well, for Adobe to execute a strategy here without it being forced to do some more expensive, dilutive M&A.
Both Instagram was not competing in the same product as Facebook at the time with the newsfeed or whatever. It was a photo sharing service that clearly created a broader addressable market that got more people to use a social network. And YouTube, people thought they were overpaying, right? And then YouTube, everyone thought it was crazy. They paid $1.6 billion for that business, and it's probably the greatest acquisition of all time. It's been the greatest managed acquisition of all time, I should say. And that business, similarly, I think Google recognized that people were going to move to video content as an alternative to text-based web content, and that it was a bigger picture opportunity than what they were pursuing and in the lane that they operated in at that time. And they were right. And in both cases, it was more about paying whatever it took to get the deal done than, hey, how many users do you have? How much revenue? How much EBITDA? What's your ARR? All that stuff goes out the window when you're sitting in that strategic driver's seat at that big company and you're saying, this is a bigger market. These guys are transforming the market. And ultimately, over time, that will eclipse us And you can say, hey, you're protecting your business, but really you're protecting your market. I mean, the market is going to go away is what the vision is. Like the market that you exist in today isn't going to exist in the same way in 5-10 years. And that's what you're trying to buy your way into.